Welcome to the InterMarket Analysis video update. This is a weekly video that's meant to supplement the daily videos that I also post. We go through a number of different things in this video. I look at the valuation of the S&P 500, not only looking back using historical numbers, but we also look at the S&P 500 valuation looking forward using analyst projections and forecasts. We also do a pretty extensive look at growth versus value, and that's pretty important. And we're seeing that switch a little bit right now. It had been getting worse with value outperforming growth. That's what tends to happen when the market gets more defensive or fears going down, and a lot of times ends up going down. Well, this past week, we saw growth improve quite a bit over value. And when that's outperforming, the market has a tendency to go up because that's more buy low, sell high. Then we look at some other different markets. We look at other areas of the stock market, other indexes. We do some comparisons. And then we look at other markets outside of the stock market because all of this works together to ultimately have an impact on how the S&P 500 behaves. This is being prepared for Monday, September 16th. I do have a thing called the SPXInvesting Program. It's free right now. There's a link below this video that will take you to the website. Also, there's a link that will take you to a video that talks about the program. If you want to email me, you're more than welcome to do that if you have any questions. And the daily video, as I mentioned, is the real foundation, where this video, the InterMarket Analysis video, is just meant to supplement the other videos that I do each week, and all of those tie into the daily video. All right, so let's go back and look at valuation. This really hasn't changed now for a number of years, looking backwards at earnings that have already been released. And what we can do is do a thing called a PE ratio, the price to earnings ratio. And we've come up with some static levels, 10, 15, and 20. And depending on where the S&P is in relation to that 10, 15, 20 scale, we know that the market is considered to be expensive, fairly priced, or inexpensive or cheap. And right now, the black line, that's the S&P 500. And then we have the red dashed line. That's a PE ratio of 20. So based on this chart, we are considered to be expensive. But we've been above this line for years now. So we don't use this as some kind of timing mechanism. We just use it to gain knowledge of what is the market like right now. We just use it more for informational purposes, but we still want to be aware of this. We want to know everything we can about what's happening, even if we don't necessarily use that to make decisions. It just gives us a good foundation of knowledge. Here's another look at that same thing, and then different events that have happened going back to 1980 and what the valuations were at that time. And you can see we're above this red dashed line for years at a time, and that's where we're at right now. Another variation of this is called the Shiller PE ratio, which smooths out earnings over a period of time, usually 10 years, and compares that with the current price of the S&P 500. And the latest reading here is 36.21. And here's a chart to show you historically how this has changed over time. And then to give us some more context, we look at the median and the mean. And for quite a while now, we've been just below 16 with the median and just above 17 with the mean, where we're coming in at over 36 right now. So this is historically expensive as well, but it can stay that way. And it has been that way now for quite some time. The market, though, looks forward. They use forward PE ratios, and this is a chart put up by Edward Yardeni showing all the different PE ratios of the indexes that we follow, but this also includes the mega cap 8 here. That's the purple line on top, and that's usually most expensive. These are the big growth stocks. And so folks don't mind if these stocks are more expensive as long as their earnings are still looking better going off into the future. We've come down a bit here lately as the mega caps have been under some pressure lately. They did improve late last week, but we're still coming in with a PE ratio looking forward of 26.4. Now, we still base this around that 10, 15, 20 scale. So we're well above 20 right now. So it's still considered expensive just in the purest sense. But that doesn't stop folks from still getting into it anyway, because these companies tend to really grow big and their earnings are really solid. So they don't mind buying something expensive, hoping that it will go up and possibly even become more expensive later. The red line is the S&P 500 coming in a little bit above 20 now at 20.9. So it's also a little bit into that expensive area. And we look at the small caps and the mid caps. That's the blue line and the green line here, coming in right around 15. We're seeing some improvement, especially with the small caps, but we've seen that earlier this year, only to have it fall back as far as their price. These companies, the reason why they're small is they don't always earn as much as the bigger companies. They usually have to borrow a lot of money, and all companies have to borrow money, but it's really the small caps that are most prone to that. And if they borrow money and interest rates are higher, of course, that's going to tie into their earnings and their profits. And that's why they tend to be valued less right now. But they are considered fairly valued, but not necessarily expensive. But you have to look under the surface and say, okay, what is the quality? Because there's a reason why these stocks are cheaper right now, where the large caps are considered to be more expensive, but they can withstand some of these things that smaller companies can't always withstand. So for the time being, though, we're fairly priced with the small and mid caps and looking a little expensive with the large caps. Now we look at some growth to value studies, and the first area that we look at is just a chart of growth all by itself. So when you look at it, at this chart independently, yeah, we're in an uptrend. We were pulling back as the market was under pressure going into the latter part of August and into September. Well, now it's starting to go back up and we're above the moving average. We also look at a pure growth index where it had also been pulling back. It came down to its 200-day moving average, but has been bouncing up. So both of these charts are looking pretty good when you look at them by themselves. Where we get some additional insight is by doing ratios between the two. And growth has been outperforming value, and it was really starting to go up here. And then it pulled back, fell below the moving average, and now has been recovering. We want growth to outperform value if we're more positive on the market. If we see value outperforming growth, that's a concern to us. And then we look at an inverse of that same chart because you can see the calculations are slightly different here. The moving average crossover occurred not quite at the same time. Well, down below, we show how value's been underperforming growth. It was starting to improve as the market was getting concerned about things, and now it's been coming down. So value has been lately underperforming and growth has been outperforming, but we want to see more of a continuation of this if we're positive on the market. If we see values starting to outperform growth, that's going to give us some concern that the market might show some weakness. Then we can do a number of different studies using indexes and ETFs, just in different time frames, just to get different perspectives on this. And yeah, it might be overkill, but this is a huge part of the market, and it allows us to say, okay, growth is looking pretty good right now, so we can be more positive about the market. Or value is looking better right now. We need to be more defensive about the market. So we've been chopping around. There's been a real battle going back and forth here lately, but we were coming down, showing how growth was underperforming. But midway through last week, we saw a big reversal that carried out through Wednesday and then through Thursday and Friday. And that has really helped the growth of value do better. Here's an inverse of that same chart showing how value's been underperforming, was starting to outperform, but we got back up to about this moving average and then things started to reverse. Here's another look using ETFs showing how growth was outperforming, fell back, and now starting to improve. And then here's another one looking at growth to value and showing how growth is improving a little bit. And I like to look at long charts, shorter charts, upside down, inverted charts, because sometimes you can get some insight that you would not necessarily see other ways. Here's another one looking at value to growth, how value was underperforming, starting to come back up, now pulling back as growth has been outperforming. And here's a couple of ETFs. And I show this in the daily video where the growth ETF has been outperforming. But you notice how we came down, we dropped below the rainbow here. We found some support, and now we've been coming up back into the rainbow. We were down a little bit on Friday, but To be more positive on things, we want to see this going up and actually go above the rainbow. If we're more negative on the market, we'll see this turn back down and drop below the rainbow. This is that same thing, but in inverse, showing how value was underperforming, starting to come back up, get above the rainbow, but now it's falling back into the rainbow. And we break this down and just look at small cap growth of value. This has really been underperforming, and we're in a downtrend here when we look at this ratio. This isn't as important for the S&P, but it's important to those that want to get into the small caps. You want to see this really going up. That's really helps the indexes to go higher. Not just a day here, a day there. We want to see the overall trend going up to show that growth is outperforming value with the small caps. Also, the same thing here with the mid caps, really underperforming, even though it's been bouncing back up lately. And let's see, this is an older chart. So this is S&P growth of value, and this is what I focus on the most. We have been improving with this ratio, and we want it to continue to go up if we're more positive, and that would really help things quite a bit for the S&P to go higher. We keep an eye on inflation. This is a monthly chart of the CRB index, and typically when this is going down, that in a broad sense is deflationary because prices are going lower for commodities. And that's what's happening right now. We're below the moving average, and the moving average is flat. Then we do a ratio down below of inflation versus deflation within the CRB index. And when we're declining like this, that means prices overall are falling as well. But we want to keep an eye on this because if prices continue to fall, it's good that prices go down, but a deflationary environment where that's really leading things, that means a weaker economy, and that could really have a damaging effect on the stock market, and things could really get bad. So there has to be this balance between inflation and deflation, and that's what we try to look at here on a longer term basis by looking at a monthly chart. Then we look at the CRB index. These are commodities. This shows you the different areas of that particular index where we're going down, and we've seen a recent death cross here on the daily chart as commodity prices in the whole anyway, and energy's been under a lot of pressure lately. They've been going down as well, and that's really produced some weakness in the CRB index. And this really isn't telling us all that much right now. This is the Baltic Dry Index, and they kind of use this together to say, okay, what does it cost to ship products, especially in the Baltics, around here? And we've just been going sideways for the most part lately. Then just to look at other markets that we don't necessarily participate in, but keep an eye on this, you can see where aluminum is starting to go into a downtrend. That's deflationary. Corn has really been falling. That's also deflationary from a food standpoint. Wheat, it's still in a downtrend here. It's bouncing back up lately, but it has been declining overall. And then this is diesel. What does it cost for 18-wheelers and railroads? This has been coming down as well. And then we keep an eye on oil. And we watch this for a number of different reasons. It can go up and stocks can go up, but we're watching this right now mainly for geopolitical reasons in case things really escalate more in the Middle East. We're still below that 70 level with oil. We keep an eye on fertilizer, not really breaking out. It's going up a little bit here, but when this really starts to go up, that's when we get concerned. And then we look at a gold to oil ratio, where gold has been doing quite well, setting highs recently, and oil's been going down. So that's why we're seeing this ratio going up. And we look at a correlation between oil and the 10-year yield, and you can see they have a pretty solid relationship with each other. Well, the 10-year yield's been coming down, and oil's been coming down too, and that relationship still is pretty strong between the two. And then here's gas, which is in a downtrend. This is probably political because it's an election year. We look at heating oil, which is in a downtrend. Natural gas also coming back up a little bit, but still in a downtrend. Copper, this is more of a barometer for the economy. Typically, when this is going up, that means the market, anyways, anticipating better economic times ahead. When copper's going down, they expect weaker times going ahead. And we were seeing copper really going up, but now it's really fallen back, and it's right around its moving averages. And we're just at the latter stages here of an uptrend. If this continues to fall, we're actually going to go into a downtrend here. And we look at a copper to gold ratio. Copper has to do more with the economy. Gold has to do with, is there going to be inflation? Is there craziness going on in the world? And this ratio has been going down, showing how copper is underperforming. Where copper has been going down, gold has been going up. So that's why we see this ratio falling. And this is also that same ratio, but we plot the 10 and the 2-year yield on here, where interest rates have been coming down and the copper to gold ratio has also been coming down. Here's gold coming out. I just follow the ETF. I don't really follow the futures contract. There's a continuous futures contract. I just use this one, which is the ETF, and it's setting an all-time high here. Of course, you got folks that they worship gold and they think it's everything, and they're just all happy right now after gold had really underperformed for many years. Silver is not setting a high, but it is in an uptrend. And we look at the closing price for gold on top. We look at the closing price for silver in the middle, and the correlation between the two is rather strong, which is kind of logically what you would think it would be. Gold and silver tend to move together. And we do a gold to silver ratio on top, and then we plot the US dollar index down here. And there's a real relationship between the precious metals and the US dollar, and the correlation between the two coming down a little bit, but it's still pretty strong. So the ratio that we see up here and the middle chart are just showing that they're tending to go in the same direction at the same time. Here's the dollar, which is in a downtrend right now, not only here on the daily chart, but also on the weekly chart that I go over in the weekly video. And we've seen a recent death cross here, and the dollar coming down typically will give support to stocks. Stock market likes a weaker dollar. That makes the conversion rates more friendly. It's the import-export relationships going back forth are more favorable. So it, from an accounting standpoint, a weaker dollar tends to show up as better earnings. This is also looking at the dollar with this trend line going down, trying to connect these tops here where we're falling back under the trend line now. And we keep an eye on the euro. And you can see this is pretty much a mirror image on top, where if you were looking at a lake, this would be the mountain, and then this is the reflection in the lake, because the euro is such a huge part of the US dollar index, and they really move very closely together. And we also keep an eye on the Japanese yen, which is now in an uptrend compared to the dollar. For years, it had been in a downtrend. Well, that whole thing that happened at the beginning of August, that was the carry trade with the Japanese yen. That's all unwinding now and starting to go away. And they're raising interest rates in Japan, where we're getting set to lower interest rates in the US. And when a central bank raises interest rates, that makes their currency more precious because it costs more to borrow that currency. And so that's why we're seeing rates going up in Japan and going down in the US, and we compare the two. But here's the yen on top and comparing that with the euro, and then on the bottom we have the dollar index here. And we just saw a recent golden cross here with the Japanese yen to the US dollar, where it had been declining quite a bit. And then everything went all crazy at the beginning of August. We fell back a little bit, and now it's starting to regain that upward move. The US dollar, or excuse me, the euro to the US dollar also coming back a little bit here, but still the I don't know why I'm saying US dollar. The euro in relation to the dollar is in an uptrend. The British pound is also in an uptrend compared to the dollar. And we look at some different indexes and ratios here, where there's a thing called the S&P 500. Of course, you're probably very familiar with that. That's a weighted index. So the bigger the company, the more impact it has on whether the S&P goes up or down. Well, because that's not necessarily fair or realistic to really gauging how things are at, there's an equal weight S&P 500 index as well. And we compare the two with each other. And usually, in a general sense, when the red line is above the bar chart, that shows a pretty healthy market. That means all the stocks in the S&P 500 are participating in the upward move. We get a little bit concerned earlier in the summer. We were seeing the S&P really going up, led by the Magnificent Seven stocks, the big monster stocks that really drive the indexes. And we were going sideways with the equal weight. Well, now we've come back more in line with what's going on, and that's more positive for the market. It just means that instead of just a few stocks driving things, now we're seeing more participation. All right, we do a same type of measure, but look at it in a little different way here. This is comparing the equal weight with the S&P itself. When this is going down, that means the equal weight's underperforming. Lately, this has been coming back up, showing again that more stocks in the S&P are participating in the upward move. And we compare stocks with commodities, and commodities are now in a downtrend. Stocks are still in an uptrend. And on a short-term basis, we switched from being in a downtrend this past week to being back in an uptrend. And you can see that here too, that stocks are outperforming commodities. Here's an inverse showing how commodities are underperforming stocks. And we do some ratios between the NASDAQ 100 and the S&P 500. Now, for a lot of 2024, the NASDAQ 100 had been really outperforming. These are the Magnificent Seven stocks. Well, those same stocks are also in the S&P 500, but there's more stocks in the S&P 500. And as we've been seeing a broader participation in the upward move, those are in the S&P 500, but they're not in the NASDAQ 100. And that's why we're starting to see the NASDAQ 100 underperforming. Now, the NASDAQ 100 is doing great all by itself, and it was just able to get back above its 50-day moving average, but it's starting to underperform. And when the market really shows some upward momentum, you'll typically see the NASDAQ 100 outperforming the S&P 500, but they both have been doing well in 2024. We look at the S&P 100, which are the biggest stocks that make up the S&P 500, and showing a little bit of an improvement here, but they were really leading things higher, the big stocks, and now we're pulling back. And so they're pretty much going sideways with this ratio now. We look at the NASDAQ, which is doing quite well itself. It also got back above its 50-day moving average this past week and compare it to the S&P 500. Both are up solid for the year, but the NASDAQ had been starting to underperform the S&P 500. Now it's starting to come back, but it's still in a longer-term uptrend here. We look at the NASDAQ 100 and the NASDAQ and see how the NASDAQ 100 is underperforming the NASDAQ. And that you can spin this a couple of different ways. That could be taken as negative because, oh my gosh, the big stocks aren't doing as well. They're not really outperforming. Okay, you can spin this as positive, saying, well, you know, the NASDAQ is a huge index. And if this is outperforming just a few stocks, that could be more positive for the overall NASDAQ itself. And we look at the mega caps, really, really big companies, and compare it with the equal weight, where the mega caps, they were really leading things higher, have come back, fell down to the 200-day moving average with this ratio, showing a little bit of an improvement, even though we fell back on Friday. And again, this going up will typically help the indexes go up, but it doesn't necessarily mean all the stocks in the index are participating. The fact that the equal weight is doing better just shows that, and you may own some of these stocks inside of the S&P, and you probably like that. If you're just doing the index itself, the S&P 500, which is what I focus on, then this is a little bit frustrating to you because there's not that real power behind the S&P 500 until we see the mega caps really outperforming the rest of the S&P. We'll look at small caps, potentially doing a little bit better here, but longer term, they've been underperforming going back to the early part of 2023. And there's been a number of different breakouts here with the small caps, only to see them fall back. And for right now, we're just not seeing much of an improvement. We're seeing a little improvement, but not really much of a change right now compared to the S&P. This is another look at this ratio. That's the red line where it's been underperforming compared to the blue line, which is the S&P itself. And we want to keep an eye on small caps versus the tech sector. When this is going down, that means the tech sector is outperforming. We've been chopping around a little bit lately. Tech was looking a little bit weaker. Now it's looking a little bit stronger. Small caps were looking a little bit stronger. And they had a good day on Friday, and they're looking okay. But we want to see this ratio going up if you favor small caps. If you favor the tech sector, you probably want to see this ratio continue to go down. We look at the biggest software companies. This isn't a ratio. This is just an index that we follow, and they are in an overall uptrend. This is mega cap, just all by itself here. These are the real leaders. You see how they fell back underneath their 50-day moving average? Now they seem to be showing some improvement. If this continues to go up, that would help the overall market. The robotics and AI ETF. AI, that's the big buzzword. That's what everybody's talking about right now. It had come down to the lower end of this rainbow, starting to bounce back up, but we're still not out of the rainbow yet. And then we do a ratio between the AI ETF and the tech sector. When this is going down, that means the AI ETF is underperforming, and it's really not doing all that well. You would think, with everybody talking about AI and this being the real craze right now, you would think this would be going up because Nvidia is included in this AI ETF, but it's underperforming when compared to the tech sector. That's the negative side. The positive side here is if you're favoring more the tech sector, you want this ratio to go down, meaning that the tech sector, which the semiconductors are a huge part of that, you want that to outperform. Here's the Wilshire 5000, a broad market measure. A positive thing that happened this past week, we got back above the 50-day moving average, but we haven't set a new all-time high, but we're not all far away from that either. And here's a big ETF here with as many stocks as we can put into this. Fell below its 50-day moving average, getting back above its 50-day moving average, and really close to setting a new all-time high. Then we look at the advanced decline line here. It was showing some weakness, but we still stayed above the moving average with the NYSE common stock. Also looking pretty good here with the S&P. The mid caps bounced off of their moving average. We actually dropped below the moving average with the small caps and were able to recapture that. And that pretty much happened in Friday's session. Dow Jones Composite Average takes the Dow, the transports, and the utilities together. A lot of the strength right now, the Dow is coming off of a recent all-time high, a little over a couple weeks ago now, but it's the utilities that are really driving things up. The transports are just floating sideways, but this ratio, this index taken by itself is looking pretty solid. Look at low volatility stocks, and these are really in a solid uptrend here. And this is another way of saying more defensive stocks, and they are even above their 50-day moving average. But when you compare it to the S&P, it's in a downtrend. It's been underperforming. Even though it was bouncing back up as the market was becoming more defensive, it's since been pulling back. Now, we'll be keeping an eye on this. If we continue to go up with this ratio, we'll see a golden cross with this ratio, and that could mean that the market is coming under some pressure. Here is Dow theory. Traditional Dow theory just looks at the Dow and the transports. I add utilities to the mix because of the Dow Jones Composite Average. And the Dow's coming back up here. Here's the recent all-time high that was set, looking okay here. The transports have just been chopping sideways. They were up and doing a little bit better, but they're not really breaking out. They've been just flat to sideways. But it's the utilities that have been showing an awful lot of strength here. And as I say in other videos, you can look at utilities in a couple of different ways. When utilities get strong, that can mean the market is getting ready to be more defensive and starting to go down. Now, why do I say more defensive? Because there are mutual funds and ETFs out there that they don't have the luxury that you and I have as individual investors. If things get rough, we can just get out of our investment and go into a money market account and just sit on the sidelines with cash. Well, these ETFs and mutual funds, they have either a prospectus or a mandate that says we will be fully invested at all times. And so if they're starting to see some trouble on the horizon, they have to stay in the market. And so they may switch over to stocks from the growth area into the value area, and they tend to hold up better if the market is getting under some pressure here. You could also see utilities as a growth area because of this attempt to switch everything over to being electric with the vehicles and all the different machines and everything that are needed to do cryptocurrency mining and all the changes that are going on. But traditionally, utilities going up has been more defensive. And we look at the transports, which are just humming along, going sideways, not really going up, not really going down now. And we do a ratio between the transports and the S&P, showing how the transports are underperforming, bouncing back up, looking a little better over the summer, but now starting to go back down. We look at another ratio between the Dow and the transports. And when this is going up overall, which it has been doing in 2024, that means the Dow is outperforming the transports. We look at a relationship between the S&P and the transports, and even though it's coming off a little bit here, there's a pretty strong correlated relationship between the two, which just means that they're going in the same direction at the same time. Then this is a variation of Dow theory, where instead of using the Dow, we use the S&P, and it's close to its all-time high. And instead of using the transports, we use the NASDAQ, since now our economy is more tech-based instead of railroad-based. And this is showing a bit of a negative divergence where we're coming back up with the S&P, but we're really underperforming lately with the NASDAQ. Even though the NASDAQ's doing well, and the NASDAQ's doing better than the NASDAQ 100, we want to see these confirming each other by breaking out about at the same time, and we're not seeing that right now. And the FANG index, Facebook, Apple, Amazon, Netflix, Google, Nvidia's in there too. A positive thing happened just in Friday's session. Well, Thursday too. We were able to get slightly above the 50-day moving average, and then we built on that a little bit in Friday's session. So this is looking better. And we're starting to come back above this longer term trend line, but we've not been able to get back above the shorter term trend line with the FANG index. This is another little variation of Dow theory. We look at an equal weight version of the S&P, close to setting a new all-time high. When we look at the equal weight QQQs, which is the NASDAQ 100, still having a ways to go to set an all-time high. So that is positive since they're both going up, but we're seeing a bit of a negative divergence here. ARC in a downtrend, not only here on the daily chart, but if you watch the weekly video, it's also in a downtrend, just treading sideways these days. This are world stocks taking out US stocks. So when we look at them individually here, it's doing really well above its 50-day moving average. Then we do a ratio between US stocks and world stocks. When this is going up, that means US stocks are outperforming, and there's a lot of choppiness going around right now, coming back up to its 50-day moving average after this past week. And then we look at a monthly chart of the S&P to global stocks all across the world here. And when this is going up, that means US stocks are outperforming. And that's what we're seeing. We're above this red line, which is a moving average, and we're continuing to go up. And we're a little bit flat, even to slightly declining here with the oscillator that measures what's happening with the chart above. So, but still looking fairly positive. Keep an eye on bonds based on price. After having this horrendous year back in 2022, well, we're seeing a lot of improvement now back in 2024. This is the 2022 decline that we saw. Even some weakness back in 2023. Now it's looking a little bit better based on price. We look at world bonds going into a recent uptrend and continuing to go higher, and that's positive for the price of bonds. This is the 7 to 10-year ETF, which is looking pretty solid right now. We're in an uptrend. The blue line's above the red line. Price is above both. We look at the RSI on top. We're above 50 and could be showing good solid momentum here, if not being overbought. And the momentum down below is measured by the MACD. That's also positive. This is a monthly chart of a stock to bond ratio. And for a long time, we've been seeing stocks really outperforming bonds. Well, we're seeing that coming down a little bit here. Now, this is a monthly chart, so it takes a while, and this can redraw by the time September actually finishes here. But this coming down is coming down as bonds have been outperforming stocks. So we just want to keep an eye on this and see if this relationship is starting to change. This is a daily chart showing how bonds are underperforming stocks, but we started to bounce back up. We came up to the moving average. Now we've been coming back down. So we have a monthly chart here that I just showed you. That's longer term. There's a weekly chart that we look at, and this is a daily chart. And we watch all of these to see, is the relationship between stocks and bonds starting to change? It did look like it might be starting to change, and it still could change, but for right now, it's not necessarily changing all that much, just showing a little bit of gyration at this point. We look at high yield corporate bonds. These are junk bonds, and they're coming in and setting recent all-time highs. These are corporate bonds, more conservative, also doing pretty well these days. Here's the stock to bond correlation, where we're starting to get into a neutral territory here. Lately, what's been happening is stocks were under pressure and bonds are going up, and that's causing this relationship to come back to neutral. There for a while, they were going in opposite directions with each other. And we do another ratio between junk bonds or riskier bonds and more conservative bonds like government bonds. And if we are at the point where interest rates have topped out with government bonds and the Fed's going to come in and start cutting rates, we would expect to see this ratio going down like we have been lately. Because folks are getting out of the riskier bonds because that gives you a higher yield. But if the government bonds are if they're setting their high rates now and then going to be going down, then folks want to be into those bonds because they can lock that in for a longer period of time. The corporate bonds also looking pretty solid here based on price. Nothing really to see here with the 10-year yield and Fibonacci charts. And we're coming back down here with the 10-year yield where we had been seeing a 40-year decline. We were starting to go up into a higher range. Now we're coming back down and we're wondering, is a shift going on? Now, for the last couple of years, it looked like, yeah, we're shifting back into the typical norm here, not the 40-year norm that we've been seeing. But with interest rates coming back down, we don't know what's going to happen economically going forward. If the economy really runs into trouble, this will continue to go down as they lower interest rates, and that could send us back down above this range where we had been breaking out. We don't know if that's going to happen. That's just what we're watching to see right now. And we look at the stocks compared to the 10-year yield, where stocks still continue to outperform because stocks now have been starting to go back up after seeing some weakness and having a really difficult week last week. Well, this week that just finished, stocks went up, interest rates are going down, and that's why you're seeing this ratio going up. Here's another look at a Fibonacci study with the 30-year yield coming down here, but we still have a ways to go to get to this Fib retracement level. And then this is the relationship between stocks and bonds that we look at. When this is going down, that means bonds are underperforming. You could say that stocks are outperforming. And we were starting to see this go back up, but as stocks have been bouncing back up this last week, this is starting to go back down again. And if you're more positive on stocks, you want to continue to see this ratio going down. Junk bonds, yeah, going back, it pretty much follows the market here, but coming off of just setting a new all-time high. And then we look at a ratio between junk bonds and government bonds, and notice how we're seeing a death cross here with this ratio. The market is anticipating that interest rates have topped out and will start to come down. And so even though junk bonds are doing fine, and lately government bonds have been doing fine, when you compare the two with each other, the junk bonds are starting to underperform here. And if this continues to fall, that means the junk bonds will be underperforming. There's a daily chart of the yields showing how interest rates have been really coming down. There's a weekly chart internationally. Also, we see where rates have been coming down. And we look at some different ratios, the S&P 500 and short-term bonds. We were coming back into the rainbow and now starting to come back up out of the rainbow. That means that stocks are outperforming short-term bonds. And we look at a broad market measure, the S&P 1500, also with short-term bonds. So this is coming out of the rainbow too. So not only is the S&P doing better, but the S&P 1500, which is a broad market measure, it's also showing some improvement, saying that there's more participation across the market as stocks have been going up. Another broad market measure with a little further out bonds, 3 to 7 years, coming back up into the high end of the rainbow. The tech sector fell down below the rainbow, but now starting to improve and coming back up into the rainbow when compared to 3 to 7 year bonds. Now, this doesn't measure price. This looks at volatility here, going up and down. The MOVE index measures the volatility of bonds, and as price has been going up, volatility has been coming down. The VIX measures the volatility of stocks, which has also been coming down as stocks have been going back up because the VIX was getting pretty high there. And then at the bottom, we look at the correlation between the two, and not really strong. But now this isn't measuring price. This is just measuring volatility, the top chart with the middle area of the chart. Then a monthly chart of the long-term bond ETF, which had been in a downtrend, starting to break out, crossing above the moving average and looking more positive longer term. And then in the bottom area, we do a bond based on price, the long-term bond with commodities. And this, ever since the beginning of 2023, shows that 30-year bonds have been outperforming commodities. And we look at different sectors. First, we look at the sector itself. There are 11 sectors that make up the S&P 500 here. Here's materials, and this is more cyclical. This tends to go more with if the economy's doing well, materials do well. If the economy's under pressure, materials tend to be under pressure. And they're in an uptrend when you look at them all by themselves. But when you compare it to the S&P, they are underperforming, even though they're ticking back up recently here. Then we look at communication. This is a growth area of the market, and we want this to do better if we want the S&P to go up. Finally, we're able to recapture their 50-day moving average. So looking better here just all by itself. and chopping sideways with the ratio between communication and the S&P, but coming back up now. This getting weaker was causing us some concern. If this can continue to go back up, that would be more positive. Now, for most of 2024, we've been really choppy. And communication's been a big part of why the market's going higher. And so communication going up and the S&P going up, that's why we're not seeing a real outperformance of this ratio right now. And we look at energy, which has been under a lot of pressure here. We watched this. It came back, got above its 50-day moving average, and now it's fallen below its 200-day moving average. Did bounce up on Thursday and Friday, but the momentum is now down, even though the longer-term trend is still up. And when we compare it to the S&P, shows how energy is underperforming the S&P 500. Financials, this is an area we've been watching too to see, okay, what's the condition of the condition of the financials, like banks and all the different things that make up the financial sector. One thing that was interesting, when we were seeing a real pullback here, this sector came down to its 50-day moving average and was able to bounce up off of that. And it's still in a pretty solid uptrend now. And when we look at it on a ratio basis, the financial sector has really been outperforming, showing some weakness now, but we've just seen a recent golden cross here when we look at this ratio. We want this to continue to do well. If this falls apart, that means we're running into some kind of problem similar to what we saw 2007 into 2008, and we want to avoid that if at all possible. Industrials also tend to go more with what's happening in the economy. Came down to the 50-day moving average, bouncing back up, and going pretty much sideways now, even though they're in a longer-term downtrend when compared to the S&P. Tech sector, this is what really drives the market. It's a huge part of the overall market. It helps the NASDAQ 100 and the S&P 500 to go higher. Came down to the 200-day moving average and was able to bounce up off of that and recapturing its 50-day moving average. And still starting to underperform, though, when we compare it to the S&P. It's been improving, but we're seeing a death cross here with this ratio. To be more positive, we want this ratio to continue to go up. If this turns and goes back down, that's going to be more negative for the S&P. Staples, this is a defensive area. Toilet paper, toothpaste. Can't get much more defensive than that. And this has been in a really solid uptrend since the beginning of 2024. And we've been watching this for a while, and it really hasn't led to much, at least to this point. Typically, what you will see, if you go back to 2021, where this was really doing strong, going into the early part of 2022, that's the market becoming more defensive. Well, we've been just climbing higher overall here lately, but it's not signaling that the market's really getting ready to go down, but we still want to keep an eye on this anyway. And it's starting to improve, and we're not quite there with the golden cross yet when we do a ratio with the S&P. This coming down is more positive for the S&P. This going up means the S&P is becoming more defensive or anticipating a decline. Real estate, they love the idea that interest rates are coming down because mortgages don't cost as much here. So this sector's been doing well. And we're seeing a recent golden cross here where it had been really underperforming the S&P, now coming back up. And that's helpful for the U.S. economy, even though housing prices are still through the roof. Utilities, again, you can look at this as a more defensive play, just coming back and setting all-time highs here with this sector. But you could also see this as a potential growth area since they're trying to switch everything over to using more electricity now. And still outperforming here when we compare the utilities to the S&P and still in an uptrend as well. So you can look at this as being more defensive or as a growth area. We're waiting to see how this will play out. We've been watching this for quite a while, kind of going with both attitudes at the same time. And then the S&P to utilities ratio, in a general sense, when this is going up, that means as the S&P is outperforming. That's not general, but even with the S&P going up, we want to see this ratio going up. When this is going down, that means utilities are underperforming. And if we treat utilities more in the defensive nature, that's the general rule, that we want to see the S&P going up and utilities going down in comparison. We'll look at healthcare, which is another defensive area, doing quite well when you look at it by itself, and still in a downtrend here. They were starting to break out with this ratio, but then lately it's been pulling back on a ratio basis. Discretionary, the thing that makes life fun. Doing better when we look at it all by itself, but still underperforming, although improving when we compare it to the S&P. Semiconductors, a massive part of the tech sector, really under a lot of weakness. That's what dragged things down a week ago. This coming back up helped drag things up higher. And we look at a ratio between energy to tech. When this is going down, that means energy is underperforming. Tech has been improving lately. Energy's been really weak. That's why we're seeing this ratio going down. And we saw this energy were really outperforming tech in 2022, where tech was under pressure and energy was more favored. Now we've seen just pretty much a reverse of that relationship. Growth versus bonds here. When the market was under some pressure, we saw this ratio going down as growth was underperforming. And it's starting to improve here, but we're still in a longer term uptrend. We want this to go up if growth stocks are going to outperform the price of bonds. And here's a ratio between the tech sector and the 10-year yield, how the tech sector is outperforming. Here's an inverse of that, showing how the rise or fall in interest rates are underperforming the tech sector. We look at a ratio between discretionary and staples. This is disappointing because we want this ratio to go up. That's more growth oriented. When this is going down, that means staples are outperforming discretionary, and that's more defensive. And this just shows that how staples are, even though they're pulling back, are still outperforming discretionary. And gold to the S&P, they're both doing well. Gold's breaking out. The S&P's been improving near an all-time high, so not really any kind of an edge when you compare the two. But when you compare gold to the dollar, gold's been going up, the dollar's been going down, so we're seeing this ratio going up as gold outperforms. This is encouraging, and I look at this for a number of different reasons, but the main one is this is holding up. These are risky loans, high leverage loans. And if this was really going down, that means the market would be anticipating economic weakness. We're not seeing that yet. Even when we were pulling back, we fell. So it came down below its 50-day moving average, but it quickly recovered that, and we're setting all-time highs with this ETF. Can give us some kind of a clue as to what the market's anticipating economically going forward. And there's other things that we look at, not just this. We don't just base everything around one chart, but this is suggesting that things are looking okay economically. We have the NYSE just coming off of setting new all-time highs and in a solid uptrend. All stocks, after dropping below the moving average, getting back above, but not at an all-time high yet. Emerging markets, kind of chopping sideways, but still in an uptrend. The Japanese Nikkei, after going back and setting an all-time high, and then this is all that crazy stuff that happened on August 5th. It's been holding up fairly well lately. And we look at the S&P on top and the home builders in the middle, and we look at the correlation between the two, and they're having a tendency to go in the same direction. When we really notice this chart is when they're diverging from each other, and that's these yellow areas that are marked down here. We were seeing that, but it didn't really lead to anything all that substantial. Now they're coming back more in line with each other. And the micro caps, the smaller companies, they are still in an uptrend. Bitcoin is in a downtrend, even though it's been bouncing up over the weekend. And this is interesting. This is a longer term oscillator where we're in a downtrend. We're rolling over here in China with emerging markets, Europe, and Japan, and we're even going down here with the S&P. It's going to take some time for the bounce that we saw this past week to reflect itself in this chart. So we're seeing still some global weakness right now, longer term. This is the intermarket analysis chart with gold being in the lead, followed by stocks. And then oil kicking back a little bit here. That's the red line. And then you have the dollar and bonds pretty much performing about the same year to date, where the price of bonds were negative for much of 2024. Some correlations. We look at the S&P 500 to the dollar. They're having a slight tendency to go in opposite directions. When we're above this band, that means they're going in the same direction. When we drop below this neutral band area here, they're going in opposite directions. The lower this goes, the more opposite they're going. When we're getting a high reading, the more they're going in the same direction at the same time. And it's kind of what we're seeing here with the S&P and oil. A pretty strong correlated relationship, but starting to weaken just a little bit. And we look at the S&P to the 10-year yield. It had been pretty strong here, but it's starting to go back into a neutral territory as the S&P has been going up and interest rates have been going down. That's why we're seeing this correlation falling. And we also compare the S&P to the 2-year yield. Also, they were going in the same direction. Both were going down there for a while. Now, we still have the 2-year yield going down, but stocks are going up, and that's why we're seeing this correlation turning and going lower. And we're seeing a very similar thing here. We're actually already neutral when we compare the tech sector, the 10-year yield. And then some long-term charts here. This is a monthly chart of the NYSE, still looking pretty solid, rolling over a little bit here, but still above an advancing moving average. And the Copic curve, which is a momentum oscillator, continues to be positive. This is a daily chart with the NYSE record high percent index. This going up is positive. We look at a monthly chart of the S&P, still looking pretty solid here, above the moving average. Rolling over just a little bit with the percentage price oscillator, but if we can hang on to some strength, this will continue to go back up. And we look at the S&P on top, and then a ratio between stocks and commodities here, showing how stocks are outperforming. And this is a variation of the chart that we saw earlier in the video. And this is a monthly chart of US stocks versus global stocks. When this is going up, that means US stocks are outperforming, but we're still flat with the KST because this is a monthly chart. It takes a while to adjust. Then at the end of the video, I go with what's positive and what's negative. My definition of positive is when the 50-day moving average is above the 200-day moving average, which we call a golden cross. So when you look at the growth and value indexes all by themselves, they are in uptrends. Copper is in an uptrend, but really choppy lately. And the British pound, the euro to the US dollar, also the Japanese yen to the US dollar. That's a relatively new addition to this list. Gold and silver are in uptrends. The big software companies, the mega caps, the FANG index, the lower volatility ETF, when you look at it by itself, staples, the Dow Jones Composite Average, and all the bonds based on price that we follow are in uptrends. The tech sector and semiconductors, the high leverage loans, the Dow, the NYSE Composite, and Wilshire, both of those are more broad market measures that we follow. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps are in longer term uptrends. All stocks and then emerging markets. And the reason I have an asterisk right here, that just tells me it's the end of the list. Then we look at the negative side, and this is when the 50-day moving average is below the 200. CRB index is now in a downtrend on the daily charts. The dollar is in a downtrend. ARK is in a downtrend, and Bitcoin continues to be in a downtrend. And then I have a period there to show me that we're at the end. So thank you. I hope you found this helpful. This video may help you by itself, but it's not necessarily meant to be a standalone video. It's meant to be used in conjunction with the other videos that I post. So please feel free to check out the daily and weekly videos. Have a great weekend, and I will talk to you in the next video.